Hi, I'm Angelo, Mena. I'm from Alexa Real Estate, and today we're going to be speaking with Sam Taylor from Crosby, Dalwood. Sam's a financial planner and he's going to be telling us a bit about the new legislative changes that have come into effect that particularly impact people who are 65 and over who are looking to downsize their homes. Thanks, Sam, for making the time to speak with us today. Why don't we just get straight into it and just tell us a bit about these new legislative changes and how they do affect people that are 65 and over.
Thanks, Angelo. That's exactly right. From 1 July 2018, there was new legislation introduced known as the Downsizer contribution. And to keep it as simple as possible, the Downsizer contribution allows anyone over the age of 65 who's owned a property for more than 10 years, and throughout that time of ownership, if it was their principal place of residence, if they were to downsize, they can use those proceeds to make a contribution into superannuation up to a cap of $300,000. There's a couple of benefits to this new legislation. The first being that superannuation is a concessionally taxed environment. Usually when you're over age 65, your superannuation is in what's called an allocated pension. And the beauty of an allocated pension is that the investments inside the fund, the earnings on those are tax-free. And also if you're to sell any of those investments, there's no capital gains tax. And keeping with the tax-free theme, the pension payments that you receive from the allocated pension, so this could be fortnightly or monthly payments, these are also received tax-free. Another benefit is that new legislation allows those that usually couldn't get money into superannuation the opportunity to do so. So this can be broken down into two parts. Those aged from 65 to 74, to be able to put money into superannuation, they need to meet what's called the work test. And the work test is working 40 hours over a consecutive 30-day period. The second part of this is once you reach age 75, you're no longer able to put money into superannuation. So the good thing about the downsizer contribution is it takes these rules out of play, and anyone over age 65 is able to put money into superannuation. With any strategy, there are advantages and there's also disadvantages. And the biggest disadvantage I see is potentially the impact it may have on people's Centrelink age pension entitlements. Centrelink currently don't assess the family home as an asset. So if you were to downsize and free up some capital, this capital would then be assessed by Centrelink. So for example, if you had a $500,000 home and you bought a new home for $400,000 and freed up capital of $100,000, and even if this was kept in the bank account or you did utilise the downsizer contribution and put money into superannuation, this would now be assessed as an asset. So depending on your level of income and assets, this may reduce your fortnightly entitlement. And in particular, if you're on a part-age pension, it's important that the additional capital that would be assessed doesn't cut you off completely, as there could be implications when looking to reapply in the future. So with any financial decision, it's important to look at the pros and cons and which solution works best for you. So it's important to engage with a financial planner when looking at planning for retirement, if downsizing is one of those considerations, and making sure you have a tailored plan for your individual circumstances.
Sam, I think to me, probably one of the biggest takeaway messages from this is that the sooner you can speak to a financial planner, the better, because you'll be able to organise in advance what you need to organise to be able to maximise the amount of funds available to you in retirement.
Exactly right.
All right, Sam, thanks so much for making the time to speak with us today.
Thank you. Thanks for having me.